folks, my name is Girish, the host for Back to Basics, another Back to Basics for another week. Today we're talking about investments. We're talking about what is a good investment, what is a bad investment, not from a stock point of view, not from any point of view, from understanding how to invest. What are you looking for? What are your needs? What are your wants? And that's what we're trying to get into. Now, the person that I brought in, he's no professional or anything like that. It is just his own opinion of how and what to look for when you want to invest on something. It could be for education, could be for Social Security, could be for anything. So let's get into the episode today and let's talk to Seth about the details of investment and what type of investments we should be doing. So Seth, how are you? And thanks for coming to Back to Basics.
Hey, thanks for having me. Pleasure to be on your show.
Yeah, so before we get into the investment details of everything else, right? So what does Back to Basic mean to you?
Sure. I think, it's really interesting because Back to Basics is really what I've been doing, I think probably for the past, it's almost 10 years at this point. So I'm a professional investor. I've been a professional investor for 18 years at this point. And I do so professionally for institutions. I've worked on various parts of Wall Street throughout my career. But probably about, the past 4 years, I started a blog. It's called, The Integrating Investor, where I really started to explore what investing is, because I was I was sitting in my professional seat. Of course, as you noted, nothing that I'm going to say should be construed as investment advice or, recommendation to buy or sell anything.
Of course,
these are just my personal opinions and telling a story here. And so I was in my seat, sitting on, what they would call an institutional trading desk. And I just gone through the great financial crisis at a very prominent bank on their trading desk. Like I was ground zero for the great financial crisis. Mm-hmm. And, starting from the great financial crisis on, the investment markets, they didn't change because, that's the wrong word, but there was a heavy dose of intervention coming into the investment markets from the central banks specifically, as well as, other kind of governments. Mm-hmm. And there were all these predictions from a lot of market participants in terms of how they would impact the markets, how they would impact the economy. Now, I'm a very kind of free market bent person. So I had I was expecting very negative things from a fallout from these interventions. You can't really, you can't really arrest kind of the invisible hand of markets. Reality would bear itself out. But what I found over the next couple of years is that none of my expectations really manifested. I was expecting high levels of inflation and market collapses, and the US dollar was going to collapse and bond yields were going to go through the roof. And I apologize if this is over some people's heads, but I was just expecting it's a lot of bad stuff to happen. And quite frankly, none of it did. So I kind of had to ask myself, like, what's going on here, right? I was faced with a contradiction. The contradiction of what I saw in reality and the contradiction of what I thought I should see.
Okay.
And I had to ask myself I had to, what's the right word? Kind of rectify this contradiction of what am I doing here? Right. What am I doing here? Right. What is investing? And that's what sort of led me down a whole path of exploration. And that's what led me to ultimately starting my blog, where I kind of which is a vehicle for me to work out these ideas outside of my professional activities. And that's really, my blog really is all about back to basics. What does back to basics mean? Back to basics mean to me? It means, from my investing perspective, is trying to figure out what actually is investing. What do we mean by investing?
Yeah, thank you again for explaining that, because you know what, it's so needed in this world of understanding everything in life, right? And one of them is investing. Now, the first thing comes in your mind when you're thinking of investment or investing on something is that you don't know that if your money's going to crash or the money's going to be in doubling, right? So to understand the science of what this whole thing is, where does a person start? Do they start by, I don't know, YouTubing or reading a book or just talking and chit-chatting with a finance guy? So what are your thoughts on that?
Yeah, I mean that I think those are very common approaches. Like how do I just get into investing?
Hmm.
And what I found out again, like throughout my career, is that the whole concept of investing is not really understood. So when I started off in investing, I started off in the equity research side of the business. So this is like the stock business. This is you work on Wall Street, and you would do the buy sell. You would issue buys or sells on certain stocks.
Mm-hmm.
So what I did for that job is we would model out company earnings, and we would put a stock price estimate. Okay, like we think stock XYZ is worth $100, and the stock is trading at 70. You'd be like, oh, that's a buy. The stock was trading at 150. You'd be like, that's a sell, right? Because it's overvalued in that instance. So that's what I did. And what I noticed is, okay, we would do all this financial modeling. We would come up. I worked on a team. We would come up with these valuations, and we would issue buys and sells. Sometimes the market would go to them, sometimes it wouldn't, right?
Mm-hmm.
It would, and more importantly, is the stocks just bounced around on their own every day, right? It had
That's
nothing
right.
to do with our modeling.
Hmm.
So I was like, all right, like what is going on? Like, why is all this stuff happening? So that was my introduction into Wall Street. Then I moved on to the bond side where I work now, and see very similar type of actions. So what I noticed is, especially over the past couple of years, because the market structure has changed in the investment markets, where I was brought up in this valuation type of framework, meaning you value a company. It's very, it's very financial statement oriented. You try and figure out how much a company is going to make in earnings, whatever your favorite earnings metric is,
Hmm.
and then based on that, there you apply what's called a multiple, right? So it's earnings times some multiple, and that would determine your price. And you could do this in that. Stocks are probably the easiest way of understanding that. So I'll stick that. But what has happened kind of in that post financial crisis period is the valuations of stocks have gone up exponentially.
Hmm.
Right? We're in like a totally different regime. And you got to ask, well, why? Why is everything expensive? Why are so few things cheap? And if you waited investing on the valuations alone, you would have made, you would have underperformed dramatically in the investment markets, and not just over like 1 or 2 years. Like we're talking like almost, a decade or so, really since like since the great financial crisis.
Yeah.
So that's a long time. That's more than just discipline. Like for me, that was a signal of, hey, there's something else going on here that I don't understand.
Hmm.
And what I really see now is that valuation approach is really a heuristic.
Hmm.
And when I went and I started to study different investing techniques, what I realized is there are different investing techniques.
Hmm.
And I had no exposure to that coming up in that kind of traditional kind of Wall Street background.
Hmm.
I started with valuation, and that's how you invest, based on valuation.
Hmm.
But what I started to realize is, hey, people started doing, there were people doing what's called technical analysis. To me, it looked like they had a stock chart, and they were just drawing lines on it, like it's trending up, it's trending down. They had all these fancy names, and to me, that seemed a little silly. But you know what? People were and are able to actually make money off of that and have investing careers off of that.
Mm-hmm.
So, okay, like that's interesting, because that I understand kind of the conceptual basis for that, but that's totally different than what I was doing. One of them's valuation, the other one says valuation doesn't matter.
Yeah.
One says price is everything, the other says price doesn't matter. And then now we live in a world of what we call quantitative analysis, which are people like building sophisticated computer models that are kind of taking a little bit of both. They're doing some valuation work. They're doing some what I'll call market trend analysis. So there's all these different ways of making money and all these different approaches to investing, which to me pretty much says like these techniques are not they're just techniques, right? They're heuristics about investing. So they're not investing, right? So investing is not valuation work. Investing is not trend analysis. Investing is not quantitative work, right? These are tools. So then what is investing, right? Well, oddly enough, no one ever answers this question. So I actually did a couple episodes on this on my YouTube show. And what I came up with this very simple the formula, right? What is investing? Investing is making money from money. Like, think about what you do with it when you invest.
Right.
You take some money that you have, you do something with it, you basically buy something, right? And then you wait. And then whenever you're, at some period of time, kind of T+1, if you will, you either have more money or less money.
Or less money, right?
So really investing is the act of taking capital, committing it, right? Most likely buying it, but we'll leave shorting aside, right? Where you would borrow money first, but you basically take money, you buy something, and then you wait and you see how much money you have at the end of it. So the whole buying process is really what investing is about. And I like to call it the act of selection, right? It's really, we are selecting stuff to buy as an investor. So we're taking money. So investing is making money from money through an act of selection. I think at least for me, when I started thinking about investing that way, I really simplified this world, because if I'm a new investor, I say, like, how do I want to invest? And most people will ask someone, how do you want to invest? And people will tell you how to invest. Oh, you should buy index funds or diversified pool of assets, or you should do valuation work, or join this chat room, or here's my technical analysis, framework. There's all these things, but no one, they're telling you what they do, but they're not telling you what investing is, right? So once I realized what investing is, then it opened up the door to me to all these options, right? I no longer just have to do valuation work. I can invest in a lot of different ways. And I think that's really, really important. It's very simple, which I think may turn some people off, because we think of investing as very complicated, and it is very complicated. But when you can think of it as making money from money, a lot of the stigma gets dropped from it. I think that's really important. So for now, like for me now, I really think about investing in two different ways. And now I'm going a little bit off on a tangent here, but this is like a new framework for me that I just really put together recently. And again, this is after over almost 2 decades of experience, and it sounds so simple. When I invest, I only invest on 2 theses. Either something has to there's either got to be a valuation framework, or there has to be what I call momentum framework. So it's value or momentum. And I wrote an article on this. It's on my site. I always forget what it's called. It's like how I process ideas into investment ideas or something like that. I think it's from November of 2020. It's like the article with like gray gears on my site if you want to look at it.
But Seth, I have a quick question, if you don't mind. So we're talking more on the stock side of things when we're talking about investments, right? Now, for many people, they're thinking stocks. Probably they're thinking of bonds. They're thinking of index also. They're thinking of insurance also, because insurance is also kind of a stock. And then obviously there's 401k, there's 529. So what are your thoughts on the mix-up and myths on these type of definition?
Sure. So these it's important too, right? What are we doing? What are these? So these are all sort of different types of vehicles. They're different types of asset classes, right? They serve kind of different purposes in what we're trying to do. So let's think. Well, let's go back. What are stocks? What are bonds? What are the retirement plans and all these things? They all have the same goal essentially. So, right, a stock is you want to buy something at price X and you want it to go, higher, right? To X plus 10 or something, right?
Yep.
Right. You're trying to appreciate. When you have a bond, you're actually buying something that is going to pay you money just by holding it. And what you want is for that not to go down. So it's the same concept. You're still making money from money, right? You're taking money, you're buying a bond, and then you're getting a stream of cash flows back over time and your return of principal.
Mm-hmm.
But things can go wrong, right? That whatever you're buying can default. If it's a corporate credit, that company can default. If it's a government, governments can default. You could also lose money through, currency devaluation, but that's a whole separate kind of ball of wax.
Right.
But it's the same thing. You're still taking your money and you're making money with the money by buying something. Now, retirement plans, index funds are just a different type of, it's a fund structure, right? It's most likely going to be in stocks, or it could be in bonds, or it could be some kind of mixture, but it's the same thing. You're taking your money and you're trying to get more money from it by buying it. But a retirement plan is just a portfolio of different investment assets. But now, these assets have different qualities to them. Some are more volatile than others. Like a stock, you're going to most likely earn, you're going to make your return based upon a appreciation, whereas a bond, you're going to, make your return by it not doing anything. And there are all sorts of kind of derivatives and a whole, kind of complicated menu options of investments in between. But in all these instances, every single instances, the idea is exactly the same. You are making your money from money, whether it's for retirement, whether it's to buy something else, that you want in the future, whether it's for, your, education, whatever you're doing, you can't invest without money. And the whole goal of investing is to make more money at the end of it.
But the thing is, isn't it less riskier with other items versus an actual stock, don't you think? Because eventually the money's going to stay and then it's going to grow slowly or rapidly, depending on whatever it is, but you will never lose it. Or am I wrong?
So there are different types of investment choices, different types of ways to invest.
Okay.
And they all have their own different kind of risk and reward, kind of dynamic, right?
Right.
So you can do something very safe on one end, which would be sit in cash. You literally just put your cash in a bank account, right? Which is not riskless, because your bank can go under, but let's just say it's a very low risk. You get paid very little on it, but your bank account, your number actually cannot fluctuate, right? It's a par value. There's no change unless your bank kind of goes away. You could of course just take a pile of cash buried in your backyard, and then you're not actually making money from money. You're just essentially preserving the money that you have. Like you're storing it, really. That's on one side. And then, there's then you could buy a government bond, for example, because governments have very low default rates, especially in the developed markets versus like an emerging market. And that's a bond. So you're guaranteed your money, you're promised your money back. And looking at history, most times you get them back from certain types of governments, and other governments, have a worse track record. And the yield that you get on that varies depending on the risk. Then we have things like stocks. Stocks, for the most part, they may pay a small dividend, but for the most part, you're going to earn your return in the appreciation of the stock. So that can go up and that can go down. And, those returns can be high, they can be low. And you have things like derivatives, which aren't stocks, but they're based upon the movement of various types of, it could be stocks, it could also be commodities, which we didn't even talk about. You could buy futures and all sorts of contracts. And then there's like cryptocurrency, which is a whole nother kind of ball wax in and of itself.
So
there are all these different, and people, commercial real estate, right? So you could go out and you could buy, strip malls across the country if you want.
But didn't want to interrupt there. But if people, they want to get into crypto, what is the first step that they need to do? Because obviously that's something totally new for people who don't know anything how to start. Do you have any basics that you can actually explain in detail on that?
Yeah. So, crypto, I mean, right now I currently, do not own any crypto. I have in the past. It's pretty simple, right? What is the purpose of this? You're going to try and make money from money, right? So how are you going to try and do that? And this goes back to sort of the framework that I was talking about earlier. I actually wrote an article on Bitcoin, using, illustrating my framework. I think it's called like Deconstructing Bitcoin Zeal into Investment Theses or something like that. That's on my website too. but that actually illustrates this. So let's take Bitcoin, for example. To me, every investment has to have one of two things going for it. It either has to have a utility value, so it has to have a purpose in reality why people need to own it, right? They have to buy it, right? So for Bitcoin, for example, people think it's going to be, a store of value, electronic payment system, the kind of like rails of a new crypto financial service, right? So there's some sort of value there, right? Like it is going to be used in this financial service economy. Therefore, it has utility. Therefore, people are going to need to buy it in order to perform actual things in reality with Bitcoin. That's going to give it a demand. So there's a demand curve, there's a supply curve, and where those intersect is going to be the price. So as demand, let's say for Bitcoin theoretically increases, because so many financial services are going to need Bitcoin to do various certain things within their financial services to run their business, that, hey, the price of Bitcoin is going to go up because the supply is capped. That would be a use case scenario. I'm not saying it's going to happen, but that's just an illustration of a use case scenario.
Sure.
So you can do a whole analysis. You could try and do an analysis around kind of the pure fundamental value of Bitcoin's utility.
Yeah.
That's one way of thinking of it. Another way of thinking of it is kind of how I think about it. A lot of crypto more these days than not. I have a kind of mixed view, but I think this is the more dominant view in the market, which is pretty simple. It's like, hey, the price is going to go up, right? I could take money now, buy Bitcoin theoretically, and then sell it in the future for more money just because more speculators are entering the market. And this could be a very complicated analysis by looking at kind of different supply and demand and like hash rates and where the institutional and money flows, and try and track down all the people who are trying to buy Bitcoin for whatever reason in the world. Like you don't care in that instance. You just care that like the momentum is going into the price. And you can buy it strictly based on that, for whatever reason it is. And it's purely a little bit more speculative in nature, but you're basically just betting on the price trend. So I like to think of it as like the value, like that use case scenario, which I call value, is really betting on a price change. So the price is going to go up. Whereas in that momentum scenario, the second one, it's really betting on a persistence of the price trend. So I think about investing in everything: stocks, bonds, crypto. Do I have a reason why the price is going to change? If so, up, like fundamentally up, then I buy it. Or do I have a reason why I think the price is going to persist in the current direction that it's going? And if it's up, then
that's a chance that someone's going to go and take anyway. I mean, that sounds more of a thin line between investment versus gambling, because it could be two different things, right? So go ahead.
Well, I actually think that they are. There's a difference. I mean, the difference between gambling and maybe investing is that in gambling, you cannot do any work. You can't gain any edge on the house. The rules are set. The odds, and you are literally betting on the odds. Whereas investing, you don't know. There are no odds, right? You don't know what the future is going to hold. And you can do an analysis to understand. You can gain an understanding of those price drivers because those numbers aren't just numbers on the screen. Those correspond to real world actions. Those correspond to people and institutions taking their money and buying and selling securities, or assets, and actually affecting the price of things. Because investing is just supply and demand. There's a demand for an investment asset, and there's a supply of them, and those intersect at the price. So if you have more buyers coming in for an asset, for whatever reason, could be speculative. Even if it's speculative, the price is going to go up. If you can do an analysis where you can understand the speculative nature and make an educated guess on the direction of that security, that is what separates gambling from investing, right? There are no odds in investing. There are odds in gambling because it's a closed system. Investing is an open system.
Seth, let me give you a use case if you don't mind. So use case is going to
Sure.
be, let's say I have, I don't know, one share equals to $20, right? And then I have a total of five shares. So how much is that? That's going to be, right? So let's say hypothetically, now the share is going to be, I don't know, $5 per share because the stocks just went down. Does that
Okay.
mean that I need to shell out more money in order to bring to the table, or do I lose everything now?
Um, yeah, I mean, that's a great question, and there's no one answer for it. I mean, this is why it matters. This is why you have to understand why you invest. Now, there's two different types of investors. Will tell you two different types of things. A value investor, like someone who is like who, let's say you are you're a value investor and you're very convicted, you've done the work and you have a valuation framework as
Mm,
your investing framework, and you're like, all right, I think I have this shares are worth are currently at $10. My work says it should be at $20. They just went to five. You know, prices move for all sorts of reasons, right?
right,
Not just based on my valuation.
right.
Well, then that's an opportunity to buy, right? That is a discount. And there are a lot of investors who will go and they will buy more when shares go down. You also have, on the flip side, you have people who will say, hey, like there's a very famous investor called his name is Paul Tudor Jones, and he famously had a sign up in his office that says losers average losers,
Mm,
meaning, hey, the market is telling you something that you're wrong, right? The market is basically saying your price of $10 a share is wrong. It's now worth $5 a share. Like you made a mistake. That's okay. You should sell your shares now, cut your losses, and then, just see what's going on here because there may be something going on that you don't know.
so you're saying take the losses and then go to the next stock, or take your losses and invest more out of that $5 to gain more money on top of that?
So I'm saying, yeah, well, so I'm saying that different styles of investors would do different things based upon their investment framework.
I see.
Right. And it's very interesting because they will look at the same situation through completely different lenses. And, the proof is ultimately in the pudding.
Hmm.
The hard thing about investing is that you're essentially predicting the future, right? You are predicting the price of assets in the future, which is a science. It is a science. That is a science part. You are trying to predict and speculate on them.
Hmm.
But part of this is, the future is by definition unknowable,
Hmm.
which means you're going to get things wrong. I mean, just by the very nature of the activity is you're going to get things wrong, and that's okay,
Hmm.
right? Another um, that is another aspect to investing that is very difficult to wrap your head around, is that you are going to get things wrong.
Hmm.
And the best investors, you'll hear people talk about these numbers. There's no science to them, but like the best, and people will say like the best investors are right, 60% of the time, right? Meaning that you're wrong a lot, and managing your risk, right? So understanding not losing your capital, your starting capital, is part of the investment game.
That's right.
Taking losses is part of investing. And again, how you do that really is going to depend on your preferred way of investing.
So,
Um,
so Seth, let me ask you this: the example that you just gave for these type of investors, right? Those type of investors are constantly looking in their monitor and monitoring that if it goes down or up. And regular people, consumers, they don't hardly look too much, and they look at once in a while, and that's how they lose money or gain money. That's a separate story altogether. But so so does that mean that he's better investor versus the other guy, or the other way around? So what are your thoughts on that? I mean, is there a particular science or way to do uh, investing, or what are your thoughts on that?
yeah, and I think I have some pretty good thoughts on it. Actually, I think the financial community is pretty good in this regard.
Hmm.
Um, the financial planning industry, or you have to also ask yourself, like, what is the purpose of investing, right? And the purpose is to make money for money, is what we said. But like, what does that money mean? Like, what is the purpose? And like, the investing actually has a purpose, right? It fits our life, right? So, for example, the day trader, the person who is monitoring investing frequently, that may be his or her job, their vocation, right? So they need money on a short-term basis. So they are looking to constantly churn money. Whereas someone else who just has in their retirement account who's not really interested in looking on it, their purpose is long-term retirement. So what you see is the way and style and the purpose of investing is different in these two cases. So that you should have different answers. So if someone's saving for retirement is inherently a different type of investor than the person who's looking to trade every day. Why? Because the purpose is the purpose it's serving in that person's life is different.
Right.
And ultimately it all needs to be served, right? Your investing is really serving a purpose in your life. If you're just going out there and just throwing money around without understanding what your purpose is, like if your purpose is just to go out there and make money, well, that's not enough. That's not clear enough of a reason. Like, how are you going to make money? Because are you going to try and make money on a daily basis, or are you more interested in long-term trends, or are you interested in yearly trends, right? There's no right answer how, but how you answer those questions is going to change your style of investing.
So the people
for example,
no, go ahead. I'm sorry. Go ahead.
Yeah. So if someone is day trading, for example, and let's take your example of the stock, this hypothetical stock that pulled back from $10 to $5. Someone who is day trading that, or who has a much shorter time horizon, is going to view that volatility of that stock much different than someone who has a time frame measured in decades, right? Because over decades, the volatility is different. And that's why it's so critical to understand, to have a purpose for your investing, right? Your investing is not just out there trying to make the most money possible. It's trying to make a money to serve a need within your life, whether that's a profession, whether that's or whether that's just for retirement, or it could even be for fun, right? Even in a more of a gambling sense, right? Or day trading. And I don't want to put those in the same category, because they're not. But even in that sense, that could serve a different purpose. Like, hey, you could take money and sort of quote unquote gamble with it, as a means of entertainment, as long as it's scaled properly to your life, right? You don't want that to be your life savings. You want that to be an amount of money that you don't care if you lose it all. And maybe you go do some like really speculative investing, as opposed to, something that you really, you have money allocated for something really important, like, down payment on a house, or, education, or retirement. Maybe you want to be a little bit more conservative with your investing, and you're willing to accept a lot less volatility in return. So it's really important to think about the purpose that your investments are going to serve in the greater context of your life.
Yeah. So I just wanted to tell my viewers, if that's okay with you, Seth, when it comes to investing, make sure that this investment is more as an educated investment, which means that if you have a little extra money, you can use that. Don't play with the money with that monthly fee that you're going to go and pay, and then you're going to get money back. I think that's what Seth is saying, right? You have to have a purpose. And the purpose is to make extra money, not the monthlies that you pay, not the utility bills, or not your mortgage, or not your car payments, or your college fees, or whatever it is, right? This is extra money, which is laying around, not doing anything, and sitting in your savings account. And maybe out of that savings account, you just want to take a couple of hundred, or maybe 1,000, whatever your thoughts are, and just invest on that and let it grow or let it drop. But don't make that as part of the day-to-day items. Am I right, Seth?
The only caveat I would say, unless you trade as a profession, there are people who,
Well, I mean, that's a separate story. I mean, that's a separate story altogether. I mean, we're talking consumers itself, right?
If this is not your full time, if this is not your full time, not your full time gig. I mean, if people make this their full time gig. I mean, there are people, very, very smart people, very sophisticated people who do nothing else but trade, and they are successful at it.
Yeah.
Because it is a science and it is understandable, it's also an art form, too, it's a little bit of both. But, if this is not your expertise,
right.
If you are, just understand what you're doing. But again, that doesn't mean you can't invest. Again, but how you should invest, that's sort of, again, context of your life should dictate the types of investment you're making and the frequency and everything like that. Should really frame it all.
Yeah. Seth, thank you again for explaining that. I mean, that's a whole bunch of education that I knew, and there's some of them I did not know. So thank you again for explaining that to me. And explaining to all the other people. I mean, yes, there are traders out there that they do day to day, minute by minute, trading, and because that's what they do, that's what they live for, right? But then there's other people who have no clue where to start, and now they have some type of idea of where to start by listening to us and trying to understand from us, and obviously they'll contact you if there's any issues, or just go to your blog too, for example, because I've seen most of the blogs and I've seen most of the YouTube interviews that you have done. A great person to chat with, and great to like dissect all the knowledge that you have about investing and what to start and what not to start. And then the only thing I think we are kind of still struggling with, even though that we got an idea from you, is the crypto, because I think that's something new for everybody, because I think that is something new that we're all going to learn eventually. But what we do know is that the old stocks and the new stocks is the stocks that we grew up with, and we know how that kind of works. Well, kind of. I mean, otherwise we would have been millionaires by now, but I mean, that's a separate topic altogether. So Seth, thank you again for coming to Back to Basics. I have one quick thing for you. How was your journey on Back to Basics, and do you have any last words for my audience and for my listeners?
Sure. Yeah. This is great. Thanks for having me. Again, it's just interesting because I am a professional, but I still had to go back to basic. I mean, I literally had to start. It wasn't easy. I literally tore down everything that I thought I knew about investing and built it back up piece by piece over the years. And it sounds really silly and like stupid, or like a waste of time. But really, it's cleared up a lot of thinking in my own brain about what I'm doing investing, what I'm doing professionally, what I'm doing personally, and really really made investing, took a lot of the complexity out of investing. So really, Back to Basics is really, I think, the great place to start for anyone interested in investing.
Yeah.
So I really appreciate the opportunity to come on. And yeah, I mean, if you're, interested in any of my ideas, I blog at integratinginvestor.com. You can follow me on Twitter, a little less on Instagram. I'm not really that active on Instagram, but, I write monthly. I write really for me. So if you're new to investing, a lot of it may be a little bit over your head. I don't mean that pejoratively. Like, I do this all day, every day. And it's really just it's like my shrink. It's really my place where I go and I work out a lot of ideas. And what I found is a lot of the ideas, like I said, in my head were wrong. Like, for example, a couple articles ago, I wrote about gold, how it's not the inflation hedge, how I thought it was. And I really dug into that. I've been doing a lot of stuff on crypto, as you mentioned, and I published an article just yesterday, which, I don't know when this is going to air, but I published it yesterday, and it really goes through some of the really complex things of crypto. And when you look at what these things actually are, when you're willing to sort of look at them in a back to basics framework and just with a clear eyes, you realize they're not very complicated. They're actually old ideas, just in kind of they're an evolution of kind of very familiar ideas. So, yeah, so I think it's a great place to start.
Yeah. Thank you again, Seth, for coming on the show and making this brighter for all of us. And hopefully we'll see each other again on Back to Basics for another part 2 of Seth. For any other stuff that you want to share with us, it'll be great to have you back again. So thank you again for coming here.
Thanks, I had a blast.
Thank you. So guys, we spoke with Seth today, and we talked about the basics of investing and the understandings of it. We did a little of crypto, but I think we talked about the way to invest on extra money that you have in your bank. When I asked Seth on a website, when we invited him to Back to Basics, I asked him, what does Back to Basic mean to him? And you know what he said is, I'll read it to you what he said. He says, rethinking our understanding of basic concepts that we could be wrong about. That's something to think about, isn't it? And that's what he actually said in many different ways in this whole 30 minutes of this episode. So there's one thing, as usual, as always, there's a quote of the day from Back to Basics, and hopefully Seth will like this. And the quote of the day is, given a 10% chance of 100 times payoff, you should take that. What does that mean? It means that, you know what, invest on something and get money back and pay something off. That's what I'm trying to say. So as usual, as always, what do I always say at the end of the episode? Everything in life goes back to basics, and that's what we did today, guys. Guys, take care, God bless, and keep on commenting on all my episodes so far. It's a blast so far for season 2, and it's gonna keep on growing. So if your comments makes me or breaks me, but that's your comments, right? And there are 3 things, this episode and every episode of mine, that is a A+, which is the content, the guest, and definitely the host. Guys, take care, God bless, and I'll see you next week. Next week's episode on Back to Basics.
Course of next 3 or 6 months, that will kind of self-correct itself. But the sticking problem is labor. There is really a shortage of skilled labor across America. It's been there probably for the last 5 to 7 years. And we think it's such a big problem that even 5 years from now, maybe on season 6 or 7, we'll still be talking about that problem.
Yeah.
And I think that's a problem that's going to be fixed very easily. And that's what's keeping it very slow in the construction industry.
So let me ask you this, right? Now, we talked about the refinancing, and we talked about refinancing in a good way, right? But I want to explain to people that how often can you refinance? I mean, you just refinance today, for example. Can I just do it 6 months from now? Or do I have to wait? What are your thoughts on that?